Today we're talking about 0% down payment mortgage. This is going to be the first video from the series of Process and Insight.
But the way I see it, you can either run from it or learn from it.
The American dream is home ownership, right? Coming to the US, working hard, and finally being able to buy a property so you can build wealth for your family and leave a legacy. That is the American dream, but as everybody knows, it is becoming less and less accessible, not only because home prices have been skyrocketing at a rate that's not comparable to personal income, so it's more and more out of reach. So a lot of people are turning to these new options of 0% down payment. A few companies that I won't list and I won't name, but there's different companies, different banks out there that are initiating programs with 0% down payment, and I want to share my thoughts essentially on when does it make sense for you to do 0% down payment and what else should you be thinking about as you make. So obviously one of the main benefits of a 0% down payment is that you have a good job, you have a good source of income, you have a very good credit, but somehow you're having a hard time saving for a down payment, especially when we're talking about houses that are $300,000, $400,000. 20% down payment is $60,000 to $80,000. That's not everybody that can put that together. So in that kind of situation, 0% down, that can be a good solution to get you access to real estate. The other thing is essentially the time that you would be spending trying to save for that down payment, you would probably be renting, and that money would be going towards somebody else's mortgage. So why not get started on your own mortgage right away and get into a house? So those are the main reasons why people do 0% down payment. I think that's pretty obvious. I don't think anybody that has the money would intentionally go for a 0% down payment. But it is important to consider the risks that come with going with a 0% down payment. And risk is really key in this situation. You should know there's a reason why banks give you 20% down payment, and it is beneficial for both the bank and the home buyer. Obviously, with a 0% down payment, the biggest impact is going to be that you're going to have a higher interest rate, just because your loan comes with a higher risk. Therefore, for the bank to be able to justify the risk that they're taking, they need to make a bigger profit, right? So for example, an $80,000 loan at a 4% interest will end up costing $137,000 after 30 years. But just a single percent up, so a 5% interest rate increase will end up costing $154,000 over 30 years. So a single percentage point in your interest rate makes a huge difference if you plan to pay the house over the full length of the mortgage. So this is just something else to think about. It seems more attractive now because you're putting less down, but you're gonna end up paying a lot more on the long term. The second thing with having 0% down is private mortgage insurance. Typically, banks, because your loan is at a higher risk, ask you to pay for this extra insurance that they need you to take because you are more likely to foreclose than other home buyers. And this PMI or this additional insurance fee that you're paying adds to your monthly payment, right? So think about the higher interest that we have today, and the higher monthly payment that you're getting, with that. On top of that, you will be paying an extra mortgage insurance that you have to pay until you build at least 20% of equity in your home, or your home appreciates, by more than 20%. But essentially the same thing, which can take a lot of time. And that extra payment doesn't go towards your interest. It doesn't go towards your principal. So it is just an extra fee that you're paying that you would not otherwise pay. And the last one, which is the most important one, which is why you pay the mortgage insurance and why you have a high interest rate, you are more likely to foreclose. The reason why you have 20% down payment is so that you have a minimum equity in your home, so that no matter what happens to the market, you can always sell and recuperate some of that money. It is unlikely. I think even if you go back to 2008, you will see that houses drop in value by more than 80%, by more than 20%, which is the initial equity that you have with a 20% down payment, is extremely unlikely. So with a 20% down payment, you're giving yourself a layer of safety so that no matter what happens to the market, you can always sell the house and still not owe anything on the house. The problem with 0% down payment is that if the house depreciates significantly and you're unable to make your payments on the house, then you will end up foreclosing on that house. In 2008, that's essentially what happened. A lot of people had adjustable rate interest and not even fixed rate interest rates, so that when the interest rate went up, their monthly payments significantly went up. And some people also lost their job, so it's almost like a double whammy, right? You get unlucky twice. Not only your home depreciated because of a crisis, and your home payments actually go up because of the higher interest rate, but also you lose your source of income, which prevents you to actually make your payment. So if you find yourself in that situation, you can't sell the house because you're underwater. Underwater means that you owe more to the bank than the value of the home. So if your home is worth $100,000, you could still owe $150,000 on it. You can't just sell it and walk away from it. Because you also don't have an income because you lost your job, you can't just sell it and take a loan for the remaining $50,000, right? Or it's gonna be very hard because they look at your source of income to essentially loan you the money. So essentially what you have to understand is when you're doing a 0% down payment, you are taking a significant financial risk. It is very significant, and that's why it is important to understand what it means for you. So what is my advice to you? I don't want to tell people not to do a 0% down payment. It is a good option. 20% is a lot of money to come by. But the recommendation that I would make for you is find ways to mitigate the financial risk that you're taking, right? Find ways to have a secure source of income, right? Obviously, in this economy and the Fed's tightening and the many layoffs that are happening, try to look at industries that you feel like are very solid. Look at your experience to see, how likely is it, or how easy would it be for you to find another job that provides you not the exact same salary, but enough to be able to sustain that mortgage payment, to be able to service that mortgage payment. Or try to find an additional source of income, whether it's a side gig or something like that, and try to give yourself a diversification of your source of income if you're deciding to go with a 0% down payment. Again, the idea here is that you're taking more risks than normal, so you need to take additional steps than normal to be able to protect yourself in case there is some sort of market downturn. Another thing, obviously, that you should be doing is saving a lot of money, right? Even if you don't put 20% down and you're making your minimum monthly payments, make sure that you're really stashing money aside so that your emergency fund is a pretty hefty, right? Heftier than what other people would need. And that's why it's important not to compare yourself to other people, because you don't know what their situation is, how much risk they're taking. In our case, if we're doing a 0% down payment, we want as much financial security as possible because we're way more at risk than other people. So again, those are some small things that you can do. And as you're setting money aside, try to get to that 20% equity as soon as possible. And that means if you're able to save money, right? If you're able to really build up your safety, your emergency fund, which is typically they say 3 to 6 months of your monthly expending, right? So not just your mortgage, but everything that you need to sustain your life. For example, in your case, you would want to go to 6 months, right? You really want that extra padding of safety if you're doing a 0% down payment. Once you've reached that 6 months of emergency fund or more, if you feel like, because of your situation, that you need even more padding, or safety, a bigger safety net, once you've reached that limit or that, threshold that you wanted to reach, you want to make extra payments towards your mortgage as soon as possible so that you can at least reach that 20% down payment and drop the PMI. I think that is the best scenario where I would recommend doing a 0% down. And one idea, for example, it doesn't have to be something crazy like, working through the night or something like that. But if you buy a house with a 0% down, immediately get a roommate, right? Get a roommate or roommates, plural, and try to use that extra source of income to give yourself that financial padding. And once you've reached it, to be able to get to that 20% down payment, right? So You have to be creative, but really the message here is 0% down payment can be outstanding. And actually, there's some banks that provide mortgage loans with no PMI and a 0% down payment. So you're not paying the extra insurance. So if you're in a situation where you're able to take advantage of those programs, like I said, try to take any step that you can to diversify and reduce your risk. So with that, those are my thoughts on 0% down payment. Let me know if you have any thoughts in the comments below, and I'll see you on the next one. Thank you.
Do you see now? It means becoming like clear water.
Water.
Right. Water can take any form, drifts without effort one moment, then pounds down in a torrent the very next.
Master, you see it? I was fluid. Like water.